got to give you credit, because when the data was coming in super weak between quarters, you're like, buy it. And your targets were aggressive going into year end.
Absolutely. So I'm still sticking with 3,100. But I think more interesting thing is what happens in 2020. And that is probably shaping up more like 3,500. Everything is falling in place. That is, the re-acceleration in the global economy is beginning. The Fed is on pause. Every central bank in the world is easing, and trade issues are getting settled away. I think the key message with the Fed is getting kind of missed in the shuffle, which is they may not cut, but they're not going to raise rates anytime soon. And I think that long-term outlook is very different than what they used to talk about before, which was, well, we'll create more room for ourselves for the next recession, or we are really worried about asset prices. Now it's all about inflation, and that's very critical for this rally.
What about 6-month targets on oil, 10-year, anything like that?
Well, so 10-year for me is probably going higher. So my outlook is probably 2%, probably going to 2.5% by middle of next year. And again, the driver of that is the rise or the re-acceleration of the global economy. So the fear that we had that we are going to get to a recession, I think is getting priced out.
But still, 3,100 isn't that far from here. So is there a risk that the stocks are near kind of overbought territory at this stage?
Well, so I think a lot of what you're seeing today is forward pricing of what is going to happen in the economy. So, 3,100, 3,150 doesn't really matter. What matters is the fact that the likelihood of any significant pullback is very small, and 2020 is looking very good.
How about you? Are you as enthusiastic about 2020?
Well, I have to agree. The Fed gave stocks a beautiful gift last week. They said we will not raise rates until we see really significant inflation. In my 5-year forecast, I don't have really significant inflation, which means I have the Fed on hold for 4 years, which is a really dramatic call. But it essentially says markets don't have to worry about the data getting better and the Fed raising rates. Good news is good news, and bad news now becomes good news. It's a great environment for stocks to flourish, especially if that global growth starts to pick up.
You're looking for neither a cut nor a hike for 4 years?
A very strange forecast, right? But what is it telling you? It's telling you that we're in a slow growth, slow inflation environment for an extended period of time that allows the Fed to stay on the sidelines and let fundamentals come back into play.
Morgan Stanley actually put out a note this morning looking at those dynamics and said that a mix of 60% equities, 40% bonds, that traditional mix that investors look for no longer works in kind of this low inflationary, lower growth environment with lower bond yields. So you work in asset allocation at Manulife. Is that kind of what you're looking at as you recommend?
It's a massive theme. Where do you get carry? Where do you get yield when bonds are giving you virtually nothing? When 40% of the global bond universe is giving you a negative yielding rate? You have to move into international. You have to be in things like emerging market debt. You have to find carry, and you're not going to find it in the same places that we've been finding it in the past.
Well, I think the 60-40 thing is kind of interesting because I think Morgan Stanley's point is extraordinarily important. That is, if bond yields are bottoming out here, then having a 60-40 portfolio and hoping that that does really well, I think is less likely. And therefore, I think adjusting that allocation, favoring equities more than bonds at this point makes perfect sense. But Francis' point with respect to finding carry the world over, whether that is in high-yield bonds in the U.S., whether that is in emerging markets, I think if you're looking for income out of your portfolio, away from government bonds is probably what you have to do, because government bond yields, in my judgment, are probably going up rather than lower.
It doesn't sound like you're worried about the dollar weakening and hurting demand for dollar-denominated assets, or a Democratic candidate spooking the market next summer.
No topic is more important from my point of view than what happens next with the U.S. dollar. But again, it comes back to the carry component. Go to a trader, tell him to be short USD, and he's going to tell you that's a really expensive trade. How much conviction do you have on this? There's an underlying support. At the same time, we know that there's some technical factors. We know that if it's risk on again, U.S. dollar can pull back. From my perspective, we're in a window of U.S. dollar weakness. That's good for equities. That's good for U.S. growth. Is it going to persist for the next 5, 6, 7 years? Probably not.
So we get all the benefits of a weaker dollar, but none of the risks?
Well, for the time being, this is a 1 to 3 month call. I like this pocket of U.S. dollar weakness. Creates a little bit of inflation in the United States, a little bit of a reprieve for global financial conditions. It's a key call to make in the next quarter.
I think the case for weakness, even if it isn't as good, I think the case for dollar strengthening meaningfully is very, very weak. So I think U.S. equities in that context make sense, but international equities and even emerging market equities equities make a lot more sense, because I think the cyclical rebound probably is going to be more pronounced in those areas than it'll be in the U.S. So international emerging market equities, I think, is where the action is going to be.
And what if Warren wins Iowa?
Well, so Warren wins Iowa. I think what we are focusing on exclusively is all of her big projects. But I think the likelihood of those big projects getting implemented is still very small. I think she's probably going to be the likely candidate. But if she is, I think toning down all of that is going to take place during the actual campaign.
In terms of trade, I know you've said that you think that the concerns surrounding peak globalization are overdone. How does that relate to what's going on with the trade agreement? Do you think that there is a likelihood that some kind of trade agreement will result in more global trade?
Well, so I think more global trade is given. As long as U.S. fiscal deficit gets to be $1 trillion from here till the end of the world, I think the likelihood that the only way it can get funded is through global trade. So global trade will continue. Whether that is through China or not is a totally different question. But I think even there, the engagement with China is significantly more rather than confrontational than I think negotiating a real agreement. That's what's going to happen over the next 12 months.